Hey guys, morning, evening, afternoon, wherever you are. Just doing a dollar yen analysis before I go into the live room and begin today's teaching around the CPI data. We'll be doing that later. If you want to get on board, go underneath. So, dollar yen, probably one of the best examples of market sentiment feeding in and a gained short bias. Ourselves in the academy have been looking at this for a long time. I mentioned it short previously there, so well done if you took it. I also mentioned it short around these areas repeatedly, and you could have taken repeated gains because you saw for a long while that you had the Bank of Japan teetering on the idea of ending negative rate stimulus. Okay, that idea is growing more and more, which is why you had this swing. You had this swing and you had very little pullbacks in the way because it seems like lots of places in the world are looking at cutting while the Bank of Japan is actually looking at putting theirs up and ending that negative rate stimulus. Of course, at that point, what would happen is people don't really want to save, the dollar, for example. They'd rather put it into yens because the rates of return on the yen is going up. So that sentiment is feeding into the market very well. You previously had an enormous fall. I also called it short there in an editor's pick. You can find that on my profile. And the reason why we look short up there again is simply because when you return to these key levels of price action and these key areas where short side impetus grows and feeds into the market, you get a fall. That previous high you saw here is what we commonly refer to as a market maker stop. Now, it actually fell more or less in line with the previous high. But you've got to understand that if you're an institutional investor or divestor, if you like, because you're shorting, you're going to look for the optimum value. Okay, and the optimum value is always going to come on a return back to the highs, 100% retracement of this downfall here. Okay, so 100% is obviously the max value you can get on a factual level because that is the maximum value it has had in this period. Way back you were higher, but in more recent times, that has been the reflective point. That has been the area that investors and traders alike have used as a reference point for the end of that market swing or the long-term market swing, if you like. Because you've got to remember, before you hit it last time, you weren't there for 20 odd years, 20 plus years, okay, 24 or so. Then you peak at 25 years later and you're just teetering around the same area. Now, you can see that the Bank of Japan similarly is using that area as a reference point because now you've got back there, they're deciding the value of the yen is too weak, okay? Because you've got to remember, ultimately, if something gets weakened so much, the market has to do its job and turn round because it becomes not really as beneficial or sustainable over time, the weakness of the currency. You can't have it losing value forever. Now, because rates are more preferable for savers and foreign cash investors, you had that massive growth, 103 to 153 area, or 152, in literally several years. So you could have known really that was going to occur if you looked at those rates and you understood the market sentiment around it. And that's why market sentiment is so important to us inside our academy. We teach it so much. It's simply because the reason for any move in any market is overall market sentiment. Yes, price action areas give you an indication of where orders are going to go in. That builds the structure of the market. But what actually moves it really is that overall sentiment. So you use these as reference points for when that sentiment changes. And at this point, you've got exactly that. You've got the rhetoric changing from the Bank of Japan. You've got many central banks around the world thinking about easing, lots of rhetoric from the Swiss bank coupled with the Japanese yen. You should see a big reversal. Now, even if you weren't looking at the news, the fact that it's gone so high already always warrants a reversal at some point. You can only have things like this happen for so long. For example, in 2012, end of the financial crisis, okay, because everyone swum to the Japanese yen as a safe haven asset, you get this rebound and then your reversal, okay, which pulls you down, on that move, just over 50%. So these reversals will always happen after long extended periods because that is always when the Bank of Japan in this case, or the central bank in that area, will start to decide to change their approach because things are too extreme. There's always an equilibrium in markets based on the state of an economy. If that economy can afford to keep their rates low as Japan could, then it's pro-business. You've seen the Nikkei go up, and you've therefore seen the saving on the safe savings, if you like, risk off. Attention goes down. So it's a really wise idea to keep your eye on that sentiment. But in short, we're at a key tech level for short entries. You can see that because you've just extended back to the same level that you've fallen away from several times. I wouldn't be entirely shocked if you come lower. Okay. If there's a change around in market sentiment or something happens with CPI data, for example, and rates aren't eased as quickly as everyone thinks or something like that, you might see it slightly higher. But if you are looking to short, okay, always in these cases, when you see it start to fall, yes, there's a bit of weakness there, might warrant a very light short, but I would probably just let it rebound as much as it can if it does, because that is where you're more likely to see a continuation of these lower highs. Okay, it's less likely at this point because it's very, very early on, or at least it's less likely you'll make money at this point because it's very early on. There's not a huge amount of sentiment. There's not a huge amount of short side value there because you've hardly retraced. Okay, you can see that with the fib on those time frames. You're just at your 23.6, which is very much a frequently hit area within that strong change in sentiment and that increased downside bias, which you can now see, which started all the way over there when you first had the chatter beginning. So these very tentative highs you might see fizzle out, but I think they're looking more and more so at a rate change in the near future. So I hope that helps, guys. Covers a few things that we look at. We're live in the live room in an hour, covering all markets, teaching everyone in there. Fantastic place to be. Loads of training recorded to learn from, and you can learn how we trade for income. Thanks for watching. Hope that helps. See you in the next video.